people keep saying real estate is the ultimate tax strategy. Is it really possible to reduce taxes to zero legally?
Yes, absolutely possible, but most people don't understand why it works or how to structure it. So they generally hear those buzzwords like cost segregation, bonus depreciation, real estate professional status, but they rarely see the full picture.
Hello there, Salim Omar here from Straight Talk CPAs. I'm joined today by our senior tax advisor, Sabir. Sabir, welcome.
Hi, Salim. Thank you for having me.
I would love for you to help us. You work with a lot of our real estate clients. You work with a lot of our tax clients, high income earners, helping them reduce their taxes. Give us this full picture, but let's start from the beginning so it's easy to understand. Why is real estate tax efficient in the first place?
Real estate is a tax efficient due to a lot of elements, but the first and the core advantage is from depreciation, right? So the IRS lets you depreciate buildings over the period of 27.5 years if it is a residential rental, and the other one is 39 years for commercial, right? So that means you can generate a paper loss each year, even if your real estate is appreciating and it generates a cash flow. So it's like depreciation is a non-cash expense, right? So that generates a paper loss. So that is the first element of this big picture, and that is the depreciation.
So I just did some math while you were sharing that 27 and a half years. So if we look at $1 million building property investment over 27 and a half years comes to $36,363 of depreciation expense per year. So not a big number by any means, is it?
Yes, definitely. So when you look at the only first element, that's what the picture suggests, and it's true. But the second element comes in now. So that is a cost segregation and the bonus depreciation. Generally, cost segregation reclass the entire asset of 27.5 years or 39 years to a different classes. So that would be a 5 years and 15 years. Like so, under that recovery period, they will reclass the elements like flooring, appliances, electrical systems into categories that depreciates faster. It would help to increase the depreciation, and those 5 and 15 years are eligible for a bonus depreciation like 100% depreciation, whereas 27.5 and 39 years does not give that 100% bonus depreciation advantage. The other element, cost segregation, comes in after the depreciation.
Got it. So the $1 million property, what you're saying is instead of $36,000, $363 of depreciation deduction, that number could be much higher. And
Yes.
how high does it get?
So that depends on the purchase price and the elements of flooring. If there is the heavy investment onto floorings and appliances, that bumps up that depreciation. But generally, they reclass 25 to 30% of the purchase price portion into that 5 and 15 years. So you can say like 25 to 30% of that $1 million would be a bonus depreciated in the first year itself.
So $250,000, $300,000 of a
Yeah.
deduction. And then what that does is creates a paper loss, not like it's a phantom loss. It's
Yes.
on paper, it's not real. Now we have a $250,000 paper loss. How does that help a business owner, a real estate investor, a high income earner?
Cost segregation and bonus depreciation gives you the paper loss, and it increases your expense on your tax return. Right now, once you have a loss, it does not automatically offset your wages and other income. So now here the other element comes in. So that is a passive loss rules limitation, right? So by default, rental properties are passive. So it can only offset passive income. It cannot offset your wages and other income, right? So to turn that passive loss into non-passive, then you have to qualify as a real estate professional status for long-term rental. So that is the other third element comes in.
We see the acronym REPS, real estate professional status. How does that fit in? What's a real estate professional? If you can share that, simplify that for us.
So I would say like the biggest misconception around this is that generally people think that they need some license to qualify as a real estate professional status, but that is not the case. So real estate professional status is an IRS term. It is defined in a tax code. So they need to qualify for two conditions. The first one is they must spend more than 750 hours in real estate activities, and their spending, like their hours, their involvement in real estate should be more than their other business. Let's say if a person have a full-time job, right? So let's say if he's spending 2000 hours under that full-time job, then he need to spend more than 2000, so like 2001 hour into the real estate activity. So more than 50% of all his time he needs to spend in real estate activities. So that's where he can qualify as a real estate professional status. And once he does, his passive losses are converted to a non-passive, and then he can offset those losses against other income, wages, or any other thing he has.
Wow, that's big. Imagine $250,000 paper loss, right? Passive paper loss that you're able to now, through the REPS status, the real estate professional status, and you're able to now take this loss and wipe out income coming from active income, non-passive
Yeah.
income coming from other things. So that can be a pretty big saving, right? If a taxpayer is in a 30, 40, 50% tax bracket, you're looking at six-figure saving. Are we on the same page with that?
Yes, yes, definitely. But it's like there is a caveat as well. So real estate professional status needs a heavy involvement, right? Around 750 hours. So if a person is doing a full-time job, he may not be able to satisfy the 750 hours. And let me say, this is a highly litigated area, like highly scrutinized and audited area when it comes to IRS. Because if a person has a full-time job, how can we involve more than that 50% of the time into this activity? So
Mm.
it gives a benefit, but not an easy one, not the low hanging fruit, I would say.
Yeah, talk to us about documentation, audit protection, because I'm sure the viewer would be concerned, right? So let's see if is there any way to ease the pain or the fear, because they want to take, this is all legitimate stuff. It's in the IRS, so it's a huge tax benefit. So is there a way to take benefit of it and do it the right way with the right documentation?
Yes, definitely. So the first documentation, and I would say like the one and only, it would be maintaining time log. So it's not like an estimation base. They need to maintain an actual time log where they are putting their time on which day, right? The first documentation is maintaining time log. Another documentation they'll need is cost segregation study, because that is only when it will be useful once they reclass the property between 5 and 15 years. So that helps to take a bonus depreciation, right? So that is another documentation they need. Just to add one thing here. So if a taxpayer is having a full-time job, it would be better if his spouse can qualify as a real estate professional status. So
Mm.
spouse would be able to create a paper loss, and then she will be able to offset the wages of the taxpayer. So it complements each other, because the spouse is not full-time employed, then she can prove 750 hours and more than 50% of her time in rental activities, real estate activities.
Makes sense. So there's ways around it. There's
Yes,
ways
definitely.
around to doing that. Who does this work for? Like, who should really pay attention to doing this?
There are a lot of opportunities here, but just to summarize, it's like high income earners, those seeking a tax reduction, it could benefit them because they have very high income. The another one is the investor who is building his portfolio around rental properties,
Hmm.
and I would say like the owner who can qualify real estate professional status, or if they have a short term rental, they can at least put in more than 100 hours, right? That's a material participation for short term rentals. Owners who can qualify real estate professional, and again the families where the spouse can qualify and owner has a high income, those complements each other as well.
Yeah, now I can see what we started off with, saying that, if you're a real estate professional or a high income earner, you could end up paying zero taxes or close to it. So makes a lot of sense. Anything else, Sabir, as we wrap up, you want to share on this topic of what we just spoke about?
Yes, so it's like there are a lot of elements involved here. It works best when it is has been given enough thoughts, it has been strategized properly, like because there is a
Hmm.
depreciation, then comes in the cost segregation, then comes in the bonus depreciation. So anybody can have these three things. Anybody can have a cost segregation, anybody can use the bonus depreciation, right? But to maximize this, a person needs to be a real estate professional status, or if it is a short term rental, they need to materially participate, then only these things work. Otherwise it will just be a suspended loss and it will be carried over to future years.
So the takeaway, real estate folks can lower your taxes significantly, but only if it is strategized in the correct way.
Yes, that's the most important thing. Like, they can't just search the reason to buy, like let's buy a rental property and we'll be able to use the cost segregation. That can't be the reason. If they are strategically thinking and qualifying as a real estate professional status, then only it will benefit them and it will align with their vision of maintaining that real estate portfolio.
Super. Thanks, Sabir, for sharing everything that you did. Folks, hope you found value in this, watching this video. If you liked it, please like, subscribe to the channel, and look forward to seeing you in the next video.